In bond investing, when you bid and you program the face value of or the amount that you want to invest in a particular bond that is on auction, when the auction derives a discounted price for that particular paper that you're purchasing, what is the impact of that discount on your investing? A discount effectively reduces the actual amount that you RTGS or pay CBK for the face value that you bidded for. The actual bid that you placed or the face value is what goes into the books or into your portfolio as your investment. But effectively, the actual amount that you pay for that instrument is lower compared to the face value that goes into the books as your investment by the amount of discount awarded. That consequently means that if you had set aside £1,000,000 as your face value for the bidded bond, and you are paying a lesser amount for that, the discount is left at hand as capital for another investment. Take an example of the FXD1 2018-20, which has attracted a discount out of the September 2025 bond auction. For an investor with a face value of 1 million in the bid, they will pay an actual amount of 979,725 shillings. And if you calculate the total coupons to term, will amount to 1,650,000 Kenya shillings. Computing the return on investment effectively for the actual amount that shall be paid of 979,725, we are getting a 13.47316 or 17 rounded off to 4 decimal places. That return on investment compared to the actual coupon for this bond, which is 13.2, then means that a discounted price in a bond auction effectively increases your return on your investment. Because the real return on investment shall increase. The normal return on your investment should be the coupon rate, but the discount, when you calculate, effectively increases that return on your investment to a higher value. The amount of discount that is left at hand as capital can be invested in another asset class or in another asset, realizing more return to the investor on top of the increased return on investment for the already purchased paper. That is the importance of a discounted paper in the bond auction. We shall be looking at the rest of the results for the two bonds forming the second auction in September 2025 after a short break. This schedule analyzes the results, the auction results for the two bonds forming the second auction in September 2025, that is the FXD1 2018-20 and FXD1 2023-25. These two bonds were issued targeting to receive 40 billion Kenya shillings. The tenure for the two papers, the FXD1 2018-20 was a remaining tenure of 12.5 years, maturing in 2038, 1st March. The second paper, FXD1 2023-25, has a remaining tenure of 22.2 years, maturing on 23rd September 2047. The total bids that were received for this second auction amounted to 97.2 billion, amounting to a 200% subscription. For the FXD1 2018-20, the actual bids or the total bids that were received amounted to 33.376 billion, which amounted to 83.44% in terms of performance, and the accepted bids were 23.505 billion, meaning that 9.871 billion worth of bids for the FXD1 2018-20 were rejected. A breakdown of the accepted bids for the FXD1 2018-20 was that competitive bidders amounted to 15.476 billion, while non-competitive bids accepted amounted to 8.02 billion. The market yield, while the FXD1 2018-20 had a coupon rate of 13.2%, the market weighted average rate for all the bids that were received stood at 13.7235%, which is way above the coupon rate for the bond. But after rejections, the market weighted average rate for the accepted bids reduced to 13.5831%, which also higher compared to the coupon rate for the bond or the bond yield. And that, comparing the bond yield of 13.2% and the auction yield or the paper yield for the FXD1 2018-20 of 13.5831, which is higher than the coupon rate for the instrument, then that means that the government, the borrower, has to compensate the investors for the increased yield in the auction, and that led to a clean price of 97.7187 per every 100, and the paper had an accrued interest of 0.2538, which when added to the clean price is giving us a dirty price of 97.9725, which is the price that we are supposed to pay for the successful bids per 100. The actual price that you pay on a successful bid, that is the dirty price, and it's the price that is quoted on the auction results. That price is composed of two elements. There is the clean price out of the auction, and there is an element of the accrued interest. The interest that has accrued from the previous, that has accrued from the last coupon payment date to the settlement date has to be purchased, because once we go into the investment as new investors, we shall be treated the same way as the initial investors or the first investors who went in the original issues and any other successive reopening of that paper. And therefore, the 97.9725 per 100, which is the actual price that we are supposed to pay for the successful bids on FXD1 2018-20, includes a 0.2538 worth of accrued interest and a clean price of 97.7187. The discount amount per 100 is 2.2813 per 100. The discount, you get it as the difference of 100, which is the par price, and the clean price of 97.7187. So 100 minus 97.7187 is what is giving us the discount amount of 2.2813 per 100. For the second paper, that is FXD1 2023-25, the actual bids that were received in total was 63.908 billion. That accounted for a performance of 159.77%. And bids accepted for FXD1 2023-25 reduced to 37.935 billion, which means that a lot of bids for this paper were rejected. That is 25.973 billion worth of received bids. And the accepted bids were composed of competitive bids amounting to 25.3 billion and non-competitive bids of 12.633 billion Kenya shillings. The total bids received had a market weighted average rate of 14.2456%. And once rejections and adjustments were done, that auction yield reduced to 14.1423%. Comparing the auction yield of 14.1423 and the actual coupon rate or the bond yield of 14.1880%, then the bond coupon is higher than the auction yield, a 14.188 and a 14.1423%, where the auction yield is lower compared to the bond coupon or the bond yield. That means that the new investors should compensate the borrower for the extra that they will be receiving in coupons compared to the auction yield. This is a case whereby the auction results or the coupon rate is higher than the prevailing market interest rate. This is a case whereby the coupon for this bond is higher than the prevailing bond yields. And for that reason, the compensation by investors to the borrower comes in the form of a premium. We have to pay an extra amount on the face values that we bidded for to cover for that extra that we shall be getting in terms of when you compare the auction yields and the bond yield. And that led to a premium of 0.2755 per 100 because the actual price or the auction price arrived was 106.2761 for every 100 shillings. And that included accrued interest of 6.0026 for every 100, meaning that the clean price, when you get the dirty price, which is the price that is quoted out of the auction, minus the accrued interest, we are left with a clean price of 100.2755 for every 100. And comparing the clean price and the par price of 100 shilling, that gives us a premium of 0.2755 for every 100. Meaning that those who bidded and the bids were succeeded for the FXD1 2023-25, they will be paying an amount extra or above their face values, while the FXD1 2018-20 successful bids will attract an actual payment that is lower than the face values that we bidded for. These two bonds were good papers for those who are looking for alternatives for drawdowns or annuities in retirement, because if the returns were favorable, if the coupon rates were within their expectable returns for their target or goal incomes, that would have remained fixed for the given remaining maturity periods of 12.5 years for the first paper and 22.2 years for the second paper. Thank you for watching and see you in our next video.